Yeah, this is a hot number. It gives the Fed permission to keep increasing interest rates and also elongates that pause and moves forward, moves out a pivot. And the question for us next year is what does this mean for the consumer and earnings and the chances of a recession? The longer Fed raises rates and keeps them high, the greater chances of a recession. That resilient consumer could start to fall apart. They're already dipping into their savings rates to spend. And then earnings, which are not realistic for 2023, also probably need to come down. So we're not surprised to see equities trading down on this. I think that, from here, it's going to be in a trading range for equities and likely more downside given where we are and the optimism that we've seen on peak inflation.
Yeah, there has been some, Betsy, and we've got OPEC and some of those problems, but there are places where, Betsy, where gas prices are below $3 now, and we know where mortgage rates are, and we know where housing prices. Are all those things meaningless if the labor market stays this strong? That's what the Fed has to be wary of.
I don't think that they're meaningless at all. What the Fed has to be worried about is it's the wage number in here that's going to be a little bit concerning. Are employers trying to hire people that just aren't showing up? I don't know that I would interpret the decline in the labor force participation as a sense that workers aren't showing up and there's a lot of demand for jobs. The household survey is surveying households and asking them what's going on. And then the employer survey is asking employers what's going on. And what we see in the household survey is fewer people said they were employed, right? There's a negative number in the household survey telling us that there were fewer jobs, fewer people holding jobs in November compared to October. And then we get this really robust number in the employer survey. What most economists do is combine those numbers. And what that says is we are slowing down. When we put these two together, the labor market's slowing down. We know the labor market's slowing down because we're seeing layoffs. And we're seeing them in certain sectors. And I would say that if you look at where the job growth was in this report, 170,000 of those jobs were in two sectors where we do desperately need people. Education and health services, which has barely recovered back to its pre-pandemic level, and leisure and hospitality, which has not recovered anywhere near its pre-pandemic level of employment. So we've got some sectors that are still in recovery and other sectors, I think, that got ahead of their skis. The surprising thing in this report is we continued to see job growth in the tech sector, information added jobs. I feel like maybe next month we're going to see them reversing course if we're to believe the layoff announcements we've been hearing about.
So, Neil, if you distill it down to that, this one particular part of the economy and one particular part of that particular part of the jobs and labor, does it make sense for the Fed just to go as high as it needs to go just to address that one sticky point that is, sort of a fly in the ointment? I mean, we want jobs, we want people hired, we even want wages to go up. Are we sure we want to just keep raising until we bring this under control? Is that the right move?
Well, it's two moves, right? It's raising rates higher, and then it's staying in place until inflation comes down. And there's a lot going on in this jobs report, but the clearest signal that we have coming out of this report is wages. They are strong and they are higher. And that is what the Fed is going to be paying attention to. Jay Powell said it this week. Wages hold the key to inflation. And right now, wages are turning inflation up, not down. Even in the ADP data, we saw a little bit of an ease, but it's an ease from a really high level. Wage growth is still double digits from where it was last year before the pandemic. So we have to keep an eye on wages, but they're not going up for the great reasons you suggest, Joe, because of growth, because of productivity. Yeah. They're going up because of labor shortages, that people are still sitting on the sidelines, and that there is not enough labor to meet the demand in key sectors, those consumer-facing sectors that were hardest hit by the pandemic, still haven't recovered.
Tyler, an average person at home might be saying, all right, wages haven't kept up with inflation. So we need wages to keep up with inflation. Okay, now wages keep up with inflation. Oh, no, that's going to cause inflation. It's just also circular. What is it we want, Tyler?
Well, I think you hit the nail on the head, and Betsy touched on this as well, that at the end of the day, different parts of the economy move at different velocities. And so throughout 2021, most of 2022, we saw wages lagging prices, wage inflation lagging price inflation. as wages start to catch up, because workers are like, hey, I've experienced a real decline in my take-home pay over the past year and a half. As wages start to catch up to prices, even though price inflation is starting to come down, that wage inflation starts to set a bit of a floor on how far down we can have some disinflation. And similarly, Betsy touched on this issue of services. I think this is a really important dynamic in the U.S. economy right now, is that we had a big surge in demand for goods and in the goods sector in 2020, 2021, into 2022. That's starting to come back down to trend. And the key question is, can this continual grinding back toward pre-pandemic trend in services sort of prop up the rest of an economy that is looking increasingly weak?